Most people are misreading XRP right now. While Bitcoin remains the center of the market, the biggest shift may be happening underneath the surface as liquidity, tokenization, institutional adoption, and utility begin reshaping the crypto landscape. In the next few minutes, we'll break down the Bitcoin setup, XRP's liquidity thesis, institutional positioning, tokenization, and why the next phase of crypto could look very different from the last. Bitcoin is currently sitting at the center of another major market debate, with prediction market participants assigning a 76% probability to Bitcoin remaining above 70,000 this month. But the number itself isn't the most important part, ladies and gentlemen. The real question is what happens next. Some investors are positioning for another major correction, while others believe Bitcoin could still have another significant move higher before the market enters its next major risk-off phase. And if Bitcoin does have another major speculative run, it could create an environment where attention across the entire crypto market accelerates. But here's where things get interesting. The longer-term story may be shifting away from speculation alone. See, institutions are increasingly focused on tokenization, stablecoins, digital settlement, liquidity, infrastructure, and artificial intelligence. And that's exactly where XRP enters the conversation. Because if crypto's next major phase is increasingly about utility rather than speculation, the question isn't simply where XRP's price goes. The question is, what role could XRP, the anointed one, actually play in the financial system being built right now? Ladies and gentlemen, if you want the solid perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. Thank you always to everyone who likes and shares each of our videos. These two things really do help out the channel. From speculation to utility. Think about the evolution of technology. Early investors often focus on the asset itself. Later, institutions start asking a completely different question. What can this technology actually do? That's where tokenization enters the conversation. Write that down, marinate on that. Tokenized securities, tokenized funds, stablecoins, digital bonds, on-chain settlement, cross-border liquidity, programmable financial infrastructure, and increasingly, artificial intelligence interacting with all of it. See, this is why XRP remains such an interesting asset to watch. See, the XRP thesis isn't simply about people buying XRP because they think the number on the screen will actually go up. The more important thesis is whether XRP becomes useful infrastructure for moving value through an increasingly digital financial system. That distinction matters because price is reacting, systems evolving. And sometimes the market price can completely obscure the structural development taking place underneath it. But here's where it gets interesting. The same market can simultaneously contain enormous speculation and genuine infrastructure development. Those two things aren't mutually exclusive. That's very important. See, Bitcoin can remain the dominant digital store of value narrative. Ethereum can remain critical to smart contracts and decentralized applications. And XRP can potentially occupy a different role around liquidity and settlement. See, the future doesn't necessarily require one winner. It could involve multiple networks serving different functions. David Schwartz in the XRP narrative, this is important. Now, let's talk about one of the narratives circulating around Ripple and XRP. Ripple CTO David Schwartz has spoken publicly about his investments and his history with digital assets. And whenever someone associated with Ripple sells an asset, invests elsewhere, or changes their personal portfolio, social media immediately turns it into a headline. Suddenly you see XRP insiders abandoning XRP. Ripple executive has lost confidence. XRP is finished, blah, 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 blah. But this is where investors need to slow down and get that Gucci conviction, that Gucci confidence, and Gucci clarity. A person's portfolio does not automatically tell you the future of a technology. People sell assets for taxes. They diversify. They buy businesses. They fund projects. They rebalance. They make mistakes. They change their financial circumstances. And none of those things automatically invalidate the underlying thesis. Schwartz has been involved with XRP from its earliest development. His historical involvement with the technology is much more relevant than trying to interpret every individual transaction as a prophecy or XRP's future. And this brings us to something incredibly important. Don't confuse an individual's portfolio decision with institutional adoption. Never do that. Those are completely different signals. Now let's talk about how much XRP is enough. Now we get into one of the most emotionally charged conversations in the XRP community. How much XRP do you actually need? You'll see people discussing 10,000 XRP, 25,000 XRP, 50,000 XRP, 100,000 XRP or more. And then you get into these enormous price targets. $100 XRP, $1,000 XRP, $10,000 XRP, baby. Well, we need to separate aspiration from mathematics. Nobody knows what XRP will be worth in 2030. Nobody knows where 1,000 XRP will make someone a millionaire. Nobody knows whether XRP will ever trade at 4 digits. Those are possibilities people speculate about. They are not guaranteed outcomes. And that's the most important, because the strongest XRP thesis doesn't require us to pretend we know the future price. See, the more interesting question is, what happens if the financial system begins putting trillions of dollars of traditional off-chain assets onto digital rails? Riddle me this, Batman. Tokenization estimates vary dramatically, and some long-term projections reach extraordinary numbers. But the exact number isn't the point. The direction is. More financial assets are becoming digital represented. More institutions are experimenting with blockchain settlement. More stablecoins are being integrated into financial infrastructure. And if that trend continues, liquidity becomes increasingly important. There's a fascinating historical parallel here. During the expansion of paper money in early modern economies, money began separating from the physical commodities people had traditionally associated with value. The important innovation wasn't simply a new piece of paper. It was the system built around the paper. Credit, settlement, banking relationships, trust, accounting, the infrastructure surrounding money became increasingly important. That transition did not happen overnight. It developed through institutions, markets, and eventually regulation. And that's an important lesson for crypto. A blockchain isn't simply valuable because a token exists. Its importance depends on what gets built around it. Liquidity, custody, settlement, compliance, applications, institutions, users. That is the difference between an interesting technology and financial infrastructure. And XRP's long-term thesis ultimately depends on whether the XRP ledger and XRP itself becomes deeply integrated into that infrastructure. Not whether somebody on social media predicts a particular price. XRP burning, the wrong metric. Now let's address the XRP burn mechanism. This is another area where the community sometimes gets distracted. XRP has a fixed maximum supply of 100 billion tokens, and transaction fees are destroyed. Write that down. But the amount burned through ordinary transactions is extremely small relative to the total supply. Write that down. So if someone tells you that the burn mechanism alone is going to create a massive supply shock and make XRP scarce overnight, that's a very weak thesis. That's never been part of the argument that interests me the most. The most interesting question is liquidity utilization. Imagine a financial institution needs access to liquidity between two currencies. Or imagine multiple institutions are connected through a digital settlement network. The important variable isn't simply how many XRP are burned. It's how much XRP is required to facilitate transactions and liquidity, how frequently it is used, how deep is the liquidity, how much capital is required, how much inventory does a financial institution need, how much XRP is held for operational purposes. Those questions are far more important. And this is where many retail discussions miss the bigger picture. Let's talk liquidity pools and the real XRP thesis. Consider a hypothetical future where XRP is used as a bridge asset between different currencies. A bank doesn't necessarily need to hold XRP forever. It could potentially use XRP to bridge liquidity between two different systems. But if demand becomes large enough, market participants may need significant liquidity available at all times. That's where liquidity pools become interesting. Instead of thinking XRP gets burned, therefore XRP goes up, think XRP becomes increasingly useful as a liquidity instrument, therefore demand for available liquidity may increase. That is a completely different thesis and is much more sophisticated. Some institutional and central bank research has discussed digital settlement, tokenized deposits, distributed ledgers, and new forms of cross-border financial infrastructure. But we need to be precise. A paper mentioning digital assets does not automatically mean an institution has committed to using XRP. A pilot does not equal global adoption. A partnership does not equal guaranteed transaction volume. And a blockchain integration does not automatically mean XRP captures all of the economic value. Those distinctions matter. Short-term noise, long-term structure. Now let's go back to history again. In 1971, the United States ended the convertibility of the dollar into gold for foreign official holders. That moment became a major turning point in the global monetary system. The world didn't stop using dollars. No. The financial system didn't disappear. No. Instead, the system evolved into something different. Currencies became increasingly based on monetary institutions. Credit systems and floating exchanges rates rather than direct convertibility into gold. Why does this matter for XRP? Because financial systems evolve without necessarily destroying everything that came before them. Bitcoin doesn't necessarily need to destroy banks. Blockchain doesn't necessarily need to eliminate the dollar. XRP, the anointed one, doesn't need to replace every payment system. The more realistic possibility is integration. Old financial structures can gradually connect with new digital infrastructure. That's the transition we should be watching. Here's the banking question. And this brings us to a question that gets asked constantly. Do we need banks anymore? I want to hear in the comments, what do you think? With crypto, artificial intelligence, and self-custody, some people believe the answer is no. And I understand this argument. Imagine a future where you control your own digital assets. You can access financial applications from a smartphone. You can potentially borrow against assets. You can potentially provide liquidity. You can transact globally. And artificial intelligence can help you automate financial decisions and businesses processes. But here's the problem. Banks don't exist only because people need somewhere to store their money. They exist because financial systems require credit, risk management, compliance, settlement, custody, underwriting, capital allocation, and institutional trust. So I don't think the future is necessarily banks versus crypto. I think the more interesting possibility is banks plus crypto infrastructure. Banks could increasingly operate on blockchain-based rails. Stablecoins could interact with traditional financial systems. Tokenized deposits could become more common. And digital assets could become part of the institutional balance sheets. That's a much more realistic transition. See, but AI changes everything. Now add artificial intelligence to the equation, and suddenly we're not just talking about a financial revolution. We're talking about an economic revolution. And AI can already analyze information, generate software, design products, automate workflows, and assist businesses. Imagine that continuing. A small business owner could potentially use AI to manage customer service, marketing, accounting, inventory, and product development. A financial institution could use AI to monitor liquidity and risk. An individual could use AI to reach investments, compare products, and automate administrative work. The barrier to entrepreneurship could fall dramatically. But there is another side. AI could also eliminate or transform large number of jobs. And that means individuals would increasingly need to adapt. The fourth industrial revolution isn't something that happens to somebody else. It's happening now. And the people who benefit most may be those who learn how to use these technologies rather than simply watching them develop. Think about the industrial revolution. The steam engine didn't create better machines. It changed transportation, manufacturing, labor, cities, trade, capital. Entire industries disappeared while entirely new industries emerged. AI could represent a similar type of structural shift. But instead of mechanizing physical labor, we're increasingly automating cognitive administrative tasks. This is so important. Let that sink in. Write this down. Marinate on this. And crypto potentially sits alongside that transformation by creating digital ownership and financial infrastructure. That's why I believe the most interesting investment question isn't which token will pump tomorrow. It's which networks could become useful when the economy itself becomes increasingly digital. That's a much bigger question. And XRP is part of that conversation because settlement and liquidity become increasingly important as digital commerce expands. The overnight XRP move. Now let's address one of the most exciting ideas in the XRP community. Could XRP suddenly move dramatically higher? Technically, extreme moves can happen in any relative liquid financial asset. But we need to be careful about turning that into a prediction. Could a liquidity shock cause a rapid repricing? I want to know what you think in the comment section. Potentially, could institutional demand accelerate unexpectedly? Let me know what you think in the comments. Potentially. Could regulatory developments change market access? Absolutely. But nobody knows whether XRP will suddenly move 2x, 5x, or 10x in 48 hours. So don't build your financial life around that assumption. The more important point is that digital assets can experience extremely fast repricing when liquidity conditions change. And XRP's long-term thesis becomes especially interesting if actual utility generates sustained demand. That's the difference between a temporary speculative squeeze and structural repricing. One is driven primarily by positioning, the other is supported by actual economic usage. Here's another way to think about this. In the 19th century, railroads transformed economies because they continued previously and connected disconnected markets. That was the most important thing, connecting everything, but continuing. The railroad itself wasn't the entire economic revolution. The real impact came from everything that could now move through the network. People, goods, capital, information. XRP's potential role in digital finance can be viewed through a similar lens. Not because XRP is literally a railroad. It isn't. But because a financial network becomes more valuable when it connects previously fragmented systems, different currencies, different banks, different jurisdictions, different assets, different settlement systems. The analogy is about connectivity, not identical technology. And that distinction matters. See, tokenization is the bigger story. Now zoom out again with me. Tokenization may ultimately be a much bigger story than any single cryptocurrency. Imagine financial assets that traditionally required days to settle becoming digitally represented. Imagine ownership being programmable. Imagine collateral moving across digital networks. Imagine stablecoins operating globally. Imagine financial institutions interacting with tokenized assets 24 hours a day. It's massive. That's the environment where blockchain infrastructure could become extremely important. And if XRP becomes a meaningful component of that ecosystem, the implications could be significant. But again, adoption must be proven. We cannot simply assume that every tokenized asset will use XRP. We cannot assume every bank will use the XRP ledger. And we cannot assume every institutional partnership translates into massive XRP demand. The market needs evidence, transaction growth, liquidity, institutional usage, regulatory clarity, real users, real settlement. That's what ultimately matters. So what could actually drive XRP demand? So what would I watch? First, institutional liquidity. Are financial institutions actually using XRP rather than simply experimenting with blockchain? Second, tokenization. Are more real-world assets moving onto blockchain? Third, stablecoins. Does the growth of stablecoins increase the need for efficient settlement infrastructure? Fourth, does regulation create clear pathways for banks, asset managers, and corporations to participate? Fifth, on-chain activity. Are we seeing genuine economic growth activity rather than speculative trading alone? This is really important. That's my favorite one. See, these are the signals that matter. Not a random social media post, not a viral price prediction, not somebody claiming that XRP is going to 10,000 next Tuesday. Fundamentals first, narrative second, price third. So here's the big picture. Where does this leave us? Bitcoin could still have another major speculative cycle. XRP could still experience enormous volatility. The crypto market could still experience another brutal correction. Nothing about this market is guaranteed. But underneath the volatility, the financial system continues evolving. Tokenization is developing, stablecoins are developing, artificial intelligence is accelerating, digital settlement is developing, institutional participation is developing, and self-custody continues to challenge traditional assumptions about who controls financial assets. That doesn't mean banks disappear tomorrow. It doesn't mean the dollar disappears. And it doesn't mean XRP automatically becomes the world's reserve asset. It means the infrastructure underneath finance is changing. And that is a story I believe deserves the most attention, ladies and gentlemen. So when you look at XRP, don't ask, what's the price? Ask, what is XRP actually becoming useful for? Because that's where the long-term thesis lives. The burn mechanism isn't the entire story. A viable price prediction isn't the entire story. An executive selling some asset isn't the entire story. Bitcoin's next move isn't the entire story. The biggest story is whether blockchain technology becomes embedded into the global financial system. And if that happens, liquidity becomes incredibly important. Settlement becomes incredibly important. Tokenization becomes incredibly important. And networks capable of connecting financial systems could become increasingly valuable. It doesn't guarantee XRP succeeds, but it explains why XRP remains one of the most closely watched digital assets in the world. So stay patient, stay informed. Don't chase green candles. Don't invest based on somebody else's guarantee. Remember, short-term noise, long-term structure, prices reacting and systems evolving. Pay attention to what's quiet. If you've enjoyed today's analysis, make sure you like the video, subscribe to the channel, and turn on notifications so you don't miss the next XRP update. And I want to hear from you. Do you believe the next major phase of crypto will be driven more by speculation or by real-world utility, tokenization, AI, and institutional adoption? Let me know in the comments. Thank you all for watching. I appreciate every single one of you. And as always, stay patient, stay informed. I'm going to see you in the next one. Hope everyone's having a blessed Sunday afternoon. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. What I'm paying attention to, ladies and gentlemen, is that the Fed chair is communicating, and no one's talking about this. He wants less Fed meetings. If they're able to do this, that is really going to upend a lot of different things. That will upend so many different things, but our narrative and thesis stays the same. Ladies and gentlemen, if you want to learn to trade, you want to learn to invest, you want to learn to position before the market moves in all the financial instruments that are traded today, come and join the Crypto Public Desk Monthly. Join over 680 active traders, investors who are taking the deeper macro research and learning how to capitalize all this. One tip from the pit will pay for your entire year subscription. Come and join us on our weekly Zoom calls that are happening right now. Understand something, ladies and gentlemen. The trick not to get caught up like sushi right now is not to FOMO and don't chase anything. We believe the markets are going higher until September 15th. On September 15th, that's an inflection point. The perception of the news may change. We're in the camp that the meetings going on are designed to push the narrative to get clarity passed. If they don't pass clarity, that's going to allow the rules of the road to be written by POTUS's team. Whether the political opposition wants that or not, understand that's the carrot in front of the donkey here right now. So that's fueling. So like we said, we expect assets to rise right now. None of this is financial advice, just my own opinion, and it retains any capacity. So that's the rules of the road here right now. Until then, watch the support lines. Don't get FOMO'd. When things start moving higher, wait for pullbacks in almost anything. We're trimming certain of our positions only because pigs get slaughtered, hogs get fatter. We let our winners run. And that's why tactically having a plan. And ladies and gentlemen, if you want to learn how to have a trading plan, an investing plan, come and join the Crypto Public Desk Monthly. I go over this all the time. Here you hear me talk about things. There you hear about positioning. But it's going to be a great week. I love everybody. And we're going to see what happens. Part of being the remora allows us to feast on the sushi. Don't be exit liquidity. Don't be exit liquidity. Low leverage or no leverage. We don't like low leverage. Being a financial mercenary, when there's chaos in the markets, it's easier to do our thing. We love you all, ladies and gentlemen. I'm going to see you on the front lines. This video is for entertainment, education purposes only. This is not financial advice. Always do your own research and consult a licensed financial advisor. First, never invest a single dollar, ever, based on watching a YouTube video. We follow the thesis here. We follow the narrative. Those are my theses. Those are my narratives that I'm willing to give away for free. If you want the whole thing, you will join the Crypto Public Desk Monthly and see why this has been so widely successful for our members since the beginning of this first news, before everything went kinetic, and the first carriers were the first floating cities were sent to the ME before all this happened. Because when we have a strong narrative, our thesis gets stronger. And again, ladies and gentlemen, the world demands more yield from long-term treasuries to finance the AI conflict, which comes back to a kilowatt conflict, which is fueled by energy. We believe that crude is going to drop. We believe that metals are going higher. Bitcoin will go higher. We believe these things. And if you want to see our price points and why, come and join us Crypto Public Desk Monthly. I love you all, ladies and gentlemen. I'm going to see you on the front lines.